What if the biggest risk to your wealth is not a market crash, a recession, or even Bitcoin's volatility? What if the real danger is believing the system is stable because it has not broken yet? What if inflation is not a temporary problem, but a permanent feature of the system you are living inside? And what if every policy decision, every election cycle, and every bailout is quietly pushing the same outcome forward? According to investor Lepard, we are not heading toward a financial reset by accident. We are being pulled toward it by math, incentives, and political reality. So the real question is not whether something breaks, but whether you understand what happens before it does. Hello everyone, and welcome back to another podcast summary video. In this one, we break down Lepard's recent conversation on the What Bitcoin Did podcast, where the topic of Bitcoin is only the starting point. What begins as a discussion about price and markets quickly expands into something much bigger that covers monetary policy, political incentives, inflation, leverage, and why the current financial system may already be past the point of no return. This was a long and dense conversation that lasted well over an hour. But don't worry, because we have distilled the most important ideas into a clear, structured breakdown, so you can understand what actually matters without listening to the entire episode. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps support the channel and keeps this content coming. Now take a breath, because this conversation forces an uncomfortable realization. The system is not broken by mistake. It is doing exactly what it was designed to do. Larry opens by addressing the fear everyone focuses on first: Bitcoin's volatility. He acknowledges that a meaningful pullback is always possible. Bitcoin could revisit the $50,000 to $60,000 range. It has done similar things before, but that possibility misses the bigger risk entirely, because history shows that the most dangerous move is not holding through volatility. It is being out of the market when it reprices. If you miss just a handful of Bitcoin's best days, your long-term returns collapse. This is not theory. It is mathematical fact. The people waiting for perfect entries are often the ones who never get them. So the question becomes uncomfortable very quickly. Is short-term volatility actually the risk? Or is it the excuse people use to avoid committing to a long-term view? One of Larry's strongest points is that investing is not about certainty. It is about probability. No one knows the exact bottom. No one knows the exact top. Anyone claiming they do is selling confidence, not insight. What matters is positioning for asymmetric outcomes. Situations where the downside is survivable, but the upside changes everything. Bitcoin fits that profile far better than most traditional assets, especially in a world where money itself is being actively distorted. So instead of asking if now is the perfect time, Larry reframes the decision. What is the probability that fiat systems improve from here? And what is the probability that scarcity becomes more valuable over time? Rather than making all-in bets, Larry describes a strategy built around rotation. When assets run far ahead of fundamentals, he trims them. When assets are deeply misunderstood or mispriced, he reallocates. For example, after silver surged dramatically, he rotated a portion of those gains into Bitcoin proxies like MicroStrategy. Not because he knew the exact timing, but because the relative value made sense. This is not prediction. It is regret minimization. And the goal is not to be perfect. It is to avoid being catastrophically wrong. From there, the conversation turns sharply toward politics. With elections looming, Larry argues that governments are structurally incentivized to stimulate. That's because economic pain is politically unacceptable and contraction is punished at the ballot box. So what happens instead? Well, spending increases, deficits expand, and monetary easing quietly returns. Keeping the economy running hot becomes a political necessity, even if it creates long-term damage. And in that environment, assets that cannot be printed become increasingly difficult to ignore. This is why Larry believes betting against Bitcoin during aggressive fiscal and monetary expansion is an uphill battle. One of the most misunderstood concepts discussed is inflation timing. Money printing does not create immediate price increases. It moves slowly, unevenly, and with long delays. Policymakers may believe they have engineered stability, only for inflation to resurface years later, embedded deeper into the system. This is not a failure of intelligence. It is the natural consequence of treating symptoms instead of causes. The can gets kicked forward, but the bill always arrives later. Larry then zooms out to what he sees as the real distortion. He believes that the cost of capital is completely broken. Interest rates are no longer set by free markets. They are managed, suppressed, and manipulated. And this creates a world where leverage is rewarded, asset holders benefit, and savers slowly lose purchasing power. Near-zero rates are framed as economic support, but they quietly function as a transfer of wealth from those who hold cash to those who control assets. Larry argues that this is not capitalism functioning poorly. It is capitalism being overridden. Every issue discussed eventually traces back to the same root, and that is broken money. Things like inequality, political instability, asset bubbles, and social tension are not isolated failures. They are downstream effects of a monetary base layer that no longer works. Larry argues that without fixing money itself, no reform can last. Everything else is cosmetic and temporary. And Bitcoin is not positioned as a cure-all. It is positioned as a correction to the foundation. According to Larry, history shows that monetary systems rarely change voluntarily. Instead, he argues, they change during crises, when the existing system becomes impossible to maintain. One speculative but high-impact scenario discussed is a sudden monetary reset involving gold and Bitcoin revaluation. A painful shock, but potentially faster and cleaner than decades of slow inflationary decay. The probability may be low, but the impact would be enormous. And that is exactly why it matters. The conversation also explores suppression. Larry says that gold has faced decades of price suppression through paper markets and derivatives. That pressure may now be breaking as demand for physical delivery increases. He argues that Bitcoin is harder to suppress because its volatility, speed, and reflexive market structure make it dangerous to short for extended periods. And when suppression fails, price does not move politely. It moves violently. So because Bitcoin's structure creates explosive upside moves, when price begins rising, short sellers are forced to cover. At the same time, new leverage enters on the long side as this feedback loop drives overshoots far beyond what feels reasonable. This is why Bitcoin never moves smoothly and why disbelief often lasts longer than expected. Larry argues that institutional adoption via ETFs, corporate treasuries, and even sovereign interest is necessary for Bitcoin's growth. But this comes with trade-offs like custodial risk, political risk, and counterparty exposure. Self-custody is framed as insurance, not against everyday volatility, but against extreme scenarios like confiscation, punitive taxation, and forced liquidation through intermediaries. The reality is, the system always tightens when it is under stress. Larry's conclusion is not dramatic. It is logical. Taxes are likely to rise, monetary repression is likely to increase, and political polarization is likely to deepen. Bitcoin is not presented as a trade. It is presented as an escape valve from a system that is mathematically unsustainable. And the only real uncertainty is timing, not direction. The most unsettling idea in this conversation is not that something will break. It is that most people will not believe it until it does. By the time the cracks are obvious, protection will be expensive or unavailable. Options shrink rapidly once confidence in the system disappears. Understanding the system early does not make you immune to volatility, but it gives you something far more valuable like context, positioning, and time. Because when money itself is the problem, the question is no longer how much you earn. It becomes what you choose to hold while everything else is being diluted away.